When most people look at the stock market, they think they are watching money react to news. That is true in the same way that watching waves tells you something about the wind. It tells you something. It does not tell you the whole thing. Because while everyone is staring at the surface, the deeper currents are already moving in another direction. That is what I think is happening right now. The public is staring at the Iran conflict, at ceasefires, at oil prices, at presidential threats, at fear gauges, at whatever headline is loud enough to make normal people wonder if they should pull money out of the market and sit in cash until the world begins making sense again. That is surface water underneath the surface. Something much more important is happening. Capital is rewiring the machine. That is the master fact of this whole story. The machine I am talking about is not a metaphor dreamed up to sound dramatic. It is the actual industrial system that will determine who gets richer during the next phase of the AI economy. Compute, memory, networking, inference, security, data center, power, sovereign infrastructure, orbital infrastructure, all of it is being rearranged while ordinary investors are hypnotized by war headlines and day-to-day volatility. And that is why I wanted to tell this story in a different way, not as a pile of isolated headlines, not as a list of top stocks, not as some childish exercise in finding the next hot ticker. I want to show you the rewiring, because if you understand what is actually being rewired, then you stop asking the wrong question. The wrong question is, what happens next week if Trump says this or Iran does that? The right question is, which companies are quietly becoming more essential to the machine while fear keeps making their prices negotiable? That is the question that can make you wealthy. I have always preferred structure over theater. Theater is for television, structure is for capital, and right now the structure is changing faster than the theater is willing to admit. Let me start with the first illusion, because if you do not break this illusion, the rest of the story will not land. People think fear is information. It is not. Fear is a condition, a reading, a market, wide sensation that can become useful only if you know what to do with it. The CNN Fear and Greed Index sitting in extreme fear for weeks on end does not by itself tell you which stock to buy. What it does tell you is that the auction hall is getting emotional, and emotional auction halls misprice things. That is the first opportunity. I call it the fear window. The fear window opens when market participants become so focused on immediate threats that they stop valuing long-duration assets properly. Not because the businesses are weaker, because the mood is weaker. And mood is one of the most temporary drivers in finance. I have made a lot of money in my life buying inside fear windows, not because I enjoyed being scared, because fear is one of the few forces that can temporarily make good things available at tolerable prices. That is what I see. Now, the market is not stupid, but it is distracted. War headlines, ceasefire headlines, oil collapsing 15% in a day, then stocks ripping, then selling, then ripping again. All of this creates the illusion that the only thing that matters is macro noise. That is false. Macro noise determines the weather. It does not determine which companies are laying track for the next decade. And the companies laying track are where I want to spend my time. The first section of the machine being rewired is sovereign AI infrastructure. That phrase sounds bureaucratic and dull, which is one reason I like it. The dull phrases often hide the most money. Nebius is a very good example. Now, if you are careless, you will treat Nebius as just another volatile AI infrastructure trade. You will look at the chart, look at the multiple, hear that it is small, hear that it is risky, and decide the whole thing is too unstable to think clearly about. That is what the average person does. I am not average, and I do not want you to think like average money. Here is what matters. NVIDIA did not put $2 billion into Nebius because it got bored one afternoon. Meta did not sign a 5-year infrastructure agreement that could run to $27 billion because it enjoys handing out giant favors. These are not symbolic moves. They are machine moves. NVIDIA is essentially saying, this company is part of the way future sovereign and regulated AI capacity gets built. Meta is saying, we are willing to route huge portions of our compute future through this build-out. That is not noise, that is structural endorsement. I call this the compute corridor. A compute corridor is what gets created when multiple elite firms begin routing future AI capacity through a smaller infrastructure player, effectively turning that player into a privately certified lane of the broader machine. Once that happens, the market has to stop thinking about the company as an isolated speculative story and start thinking about it as a corridor through which future earnings may travel. That can change valuation completely. What makes Nebius especially interesting is that it sits in a place many investors still do not fully appreciate. The world does not merely need more AI. It needs more AI in specific legal, national, and regulatory contexts, sovereign, regulated, defensible. The next phase of this industry is not just about building the biggest cloud. It is about who can build trusted cloud infrastructure for entities that cannot simply dump their most sensitive compute workloads into any random stack. That is a huge market. Now, does Nebius carry risk? Of course, the stock is volatile, the build-out is aggressive, the expectations are enormous, fine. But again, we must learn to separate the fear window from the business line. If a company is being given billions of dollars in commitments, is guiding to a massive ramp in annual recurring revenue, and is being invited into the inner circle of the most important hardware platform in the world, then I am very interested in what the market is willing to offer me when everyone is still treating it like an exotic side story. That is how I think. I do not buy certainty, I buy asymmetry. And Nebius has a kind of asymmetry I respect. The second section of the machine being rewired is what I call the operating system floor, that is Microsoft. Now, people love to complicate Microsoft because it is too obvious a company to make them feel clever. I have noticed that many investors would rather discuss tiny speculative names than study one of the greatest business machines ever built, simply because studying greatness does not flatter their ego in the same way. I have no such weakness. If a world-class company trades down to a long-term floor while the business continues to grow sales, profits, and earnings from an already gigantic base, then I do not care whether it is too famous to impress anybody at a cocktail party. I care whether it is a good use of capital. And Microsoft is the fact that it has fallen to its 200-week moving average for the first time in over a decade matters, not because moving averages are magic, but because very long-term floors often attract patient capital in exactly the kind of stocks that become cornerstones of fortunes. This is what Charlie Munger understood very well and what many people still do not. A quality asset at a long-term floor is not the same thing as a random dip. It is a reset of entry conditions. I call this the operating system floor because Microsoft is not just a company. It is digital infrastructure with a stock ticker. The world runs through it. Cloud office workflows, enterprise software, developer ecosystems, cybersecurity, AI services. Everything when a business like that comes down 20% while still growing the way the source material describes. I pay very close attention because a company like Microsoft does not need fantasy to justify ownership. It needs time. That is a much better thing to own. You see, the market has a bad habit during thematic manias. It starts treating durable giants as if they were somehow less interesting than the newest story. Then when volatility arrives, everything gets repriced at once. And suddenly the giants with real earnings, real cash, real moats, and real customers are being sold alongside the dream machines. That is when you can get lucky without being silly. This is one of those moments. Microsoft is not the second worst performer in the Magnificent Seven because its business is sick. It is down because the market has become selective, frightened, and impatient in a period when quality is being offered at a slight discount. I like slight discounts on greatness. The market tends to regret giving them. Now, I want to connect Microsoft to the rest of the rewiring because the story does not stop at cheap mega cap. The AI economy is shifting from pure model fascination to practical enterprise deployment. That matters enormously. In the early phase, the market pays for possibility. In the later phase, it pays for distribution and embedment. Microsoft has both. It already lives inside the workflows of the world. So every increment of AI capability it delivers does not have to fight for a new front door. It can walk through doors it already owns. That is incredibly valuable. It means Microsoft is not just part of the AI story. It is one of the operating systems through which the AI story enters business reality. That is a beautiful position to own. The third section of the machine being rewired is connectivity inside the rack. Now we are talking about Marvell. This is where things get more technical. And that usually scares away the tourists. Good tourists make prices less efficient for the rest of us. Here is the simple version. AI data centers are not merely giant rooms full of chips. They are systems. The system only works if everything can talk to everything else fast enough, efficiently enough, and at scale. CPUs, GPUs, DPUs, network cards, switches, interconnects. All of it has to work as one machine. NVIDIA understands that better than anyone, which is why the NVLink Fusion partnership matters. When NVIDIA brings Marvell into the inner circle and says, in effect, you can now build custom AI silicon and networking gear that plugs into our ecosystem at full speed. It is not merely complementing Marvell, it is expanding the machine. And the moment that happens, Marvell's role changes. It is no longer just another semiconductor company fighting for design wins. It becomes one of the sanctioned bridges inside the dominant AI stack. I call this the bridge toll. A bridge toll exists when a company owns a necessary passage point inside a dominant infrastructure system. The bridge does not have to be the whole city. It simply has to remain unavoidable enough that every expansion of the city sends more traffic across it. That is the right way to think about Marvell as the rack becomes more integrated. As custom silicon becomes more important, as silicon photonics and optical interconnects move from research topic to commercial necessity, the bridge gets busier. And when the bridge gets busier, the owner gets richer. Now, the acquisition of celestial AI is not some decorative aid. On-silicon photonics matters because moving data with light rather than only through copper becomes more attractive as compute density and data movement demands explode. This is the sort of thing that sounds niche right before it becomes essential. Markets often underprice essential things when they still sound technical. That is an old pattern. Marvell's opportunity is not simply that NVIDIA invested. Its opportunity is that the system is becoming more modular, more interconnected, and more dependent on high-performance data movement between compute elements that were previously thought of too separately. In a simpler market, people buy the GPU manufacturer and stop there. In a rewiring market, the people who own the rack plumbing can do very well. That is where Marvell sits. Now let us move to ARM, because this is one of those stories where the market has not fully decided whether it is genius or self-harm. I understand the excitement. ARM has spent decades licensing architecture rather than fully stepping into the ring as a branded chip provider. That is a beautiful business when the ecosystem is healthy, because everybody pays you and you do not directly antagonize too many of your customers. The moment you launch your own self-branded AI CPU, the picture changes. Now, philosophically, I admire ambition. Economically, I respect incentives even more. If ARM starts making its own serious AI chip pushes, it is no longer only the neutral arms dealer. It risks becoming a participant in the same war its customers are already fighting. That is not a trivial shift. It changes who feels aligned, who feels threatened, and how the whole CPU side of the AI data center market may evolve. I am not saying ARM cannot succeed. I am saying the move is more complex than the headlines make it sound. This is why I do not rush. I call this the landlord becomes tenant problem. A landlord becomes tenant problem appears when a company with a wonderful neutral business model decides to step directly into the operating arena where its customers already live. Sometimes that creates a bigger opportunity. Sometimes it destabilizes the very ecosystem that made the original model so wonderful. I want to see more before I get romantic about it, but the broader takeaway still matters. The CPU layer of AI infrastructure is being rethought. That means every company tied to the control plane of data centers deserves re-examination. Some will win. Some will confuse themselves. All of them will matter more than they did before. That is rewiring. The fourth section of the machine is security. This is where Anthropic becomes interesting, in a way most people still do not appreciate. The average person thinks in model league tables. Which company has the smartest model? Which model is better at coding? Which model beats? Which benchmark? Fine, that is surface competition. The deeper competition is who becomes embedded in the defensive nervous system of the enterprise and state. Anthropic's deals with Google and Broadcom for massive TPU capacity matter financially. Obviously, access to 4.5 gigawatts of TPU-backed compute is not a hobby. It is industrial. Scale ambition. But what interests me even more is Project Glasswing. When a company takes a frontier model so powerful that it is not comfortable releasing it broadly, then turns around and gives early access to a coalition that includes cybersecurity giants, cloud providers, infrastructure firms, and major enterprises. Something important is happening. The model is no longer merely a product. It is becoming a defensive instrument that matters. I call this the defensive privilege layer. A defensive privilege layer emerges when a frontier AI company begins granting select participants access to capabilities that materially improve their ability to defend infrastructure, code bases, and networks against the next wave of AI-enabled threats. The companies inside that layer do not just get a better tool. They get time, they get visibility, they get asymmetry. That asymmetry can be worth a fortune. CrowdStrike and Palo Alto networks are obvious beneficiaries because the future of cybersecurity will not be won by static defenses against yesterday's attacks. It will be won by who can see the new attack surface first, simulate it first, detect it first, and patch it first. If Anthropic is becoming a core infrastructure and security partner to enterprises through relationships like this, then the security companies sitting closest to that power are in a very attractive position. This is why I keep saying the machine is being rewired. People hear Anthropic and think, another OpenAI competitor. That is far too shallow. Anthropic is becoming part of the industrial security stack around frontier compute, and the companies surrounding it need to be revalued accordingly. This is not only an AI story, it is a security architecture story that is much bigger. The fifth section of the machine is memory. And here is where the market made one of its classic mistakes again. A technical breakthrough appears. People immediately assume that if the breakthrough reduces resource intensity, demand for the resource must fall. That sounds rational. It often is not. Google DeepMind's TurboQuant breakthrough is a perfect example. If you can shrink KV cache memory needs massively and improve inference efficiency, the shallow reading is that memory demand should collapse. That is the kind of reading a spreadsheet makes before it learns economics. I have always been much more interested in Jevons paradox than in first-order reactions because markets repeatedly forget that when a critical input becomes more efficient, total demand for the larger system often rises rather than falls. That is exactly what happened around DeepSeek and compute, and I believe that is exactly why memory is more interesting. Now, not less. If AI becomes cheaper to run, more people run it. If more people run it, total system demand broadens. If models get larger context windows, more persistent memory requirements, more real-time commercial applications, and more production deployment, memory remains under pressure. That is the key. I call this the cheaper, faster, hungrier loop. The cheaper, faster, hungrier loop is what happens when efficiency gains do not shrink the market, but instead make the market bigger, more accessible, and more ravenous. It is one of the most reliable patterns in technology investing, and people still act surprised every time. This is why Micron's earnings matter so much. Memory is not a commodity in the old sleepy sense anymore. Inside the AI stack, memory has become performance, latency, throughput, and therefore strategic capability. That is a very different role. When a component changes from cheap interchangeable part to constrained performance determinant, the economics around it can improve dramatically. And that is why the dedicated DRAM ETF launch matters as well. Capital is now organizing itself around the idea that memory is not incidental to the AI build-out. It is one of the most constrained, profitable, and strategically necessary layers. That is a huge shift in how the market thinks. And whenever the market changes how it thinks about a layer, fortunes can follow. Now, if you own Micron or broad memory exposure or South Korean exposure through funds that give you Samsung and SK Hynix, what you are really owning is not just bits in a chip. You are owning a piece of the layer that makes larger, smarter, more persistent, more responsive AI possible. That layer will matter more tomorrow than it did yesterday. That is the whole point. The sixth and final section of the machine is orbital compute. And this is where everything begins to sound like science fiction, right before it becomes an FCC filing and a capital allocation plan. SpaceX is not just about rockets. That is how children think about it. Adults should be looking at the package reusable launch. Starlink, XAI, potential orbital data centers, Terafab, Intel as manufacturing partner. The ambition here is not to be a better aerospace company. The ambition is to become a vertically integrated compute and transport civilization stack. That is a different order of magnitude. Now, Elon called some valuation rumors nonsense. Fine valuation gossip does not interest me much at this stage. What interests me is the direction of the machine. If SpaceX goes public and the market begins to seriously price an entity that combines launch dominance, satellite internet, frontier AI, and a roadmap to space-based compute infrastructure, then the consequences will reach much farther than the stock itself. That is the whole reason I keep returning to this. The SpaceX IPO is not just an IPO, it is a category legitimization event. The market will be forced to ask a very uncomfortable question. If one company can combine transport connectivity, AI, and orbital infrastructure into one strategic machine, then which other public companies feed, enable, or benefit from that machine, That question will send money outward, not just inward. This is why Intel suddenly matters more than people think, not because Intel has become magically wonderful overnight. Markets do not work that way. But if Intel becomes a serious manufacturing partner in a facility meant to support a terawatt-scale compute ambition, then Intel is no longer only a troubled legacy chip company trying to find itself. It becomes part of an extraordinary strategic project. Projects can change the fate of companies. Not always, but sometimes enough. Now, do I think orbital data centers are riskless or imminent in the childish sense? Do I think the strategic direction matters? Now, absolutely. The market consistently underestimates the value of owning a foothold in a future system before that system becomes normal enough for everyone else to discuss it calmly. That is how big money gets made. Not after the vision feels safe, before the vision feels inevitable. Now, let me step back and tell you what I think this entire document is really saying. Underneath all the stock ideas and the headlines and the sponsor interruptions and the rapid-fire market recap style, it is saying that the next phase of massive growth will not belong only to the companies making the most noise. It will belong to the companies becoming the most necessary. That is the rewiring. Nebius becoming a sovereign compute corridor, Microsoft sitting at the operating system floor of enterprise AI, Marvel owning part of the bridge toll inside the rack, Anthropic and the Security Coalition creating a defensive privilege layer, memory becoming part of the cheaper, faster, hungrier loop. SpaceX turning orbital compute from fantasy into strategic direction. These are not isolated stories. They are the same story told from different sections of the machine. And that is why I think most people are still looking at the market incorrectly. They are looking for top stocks. I am looking for the rewiring. They are asking which ticker wins. I am asking which layers become unavoidable. They are worrying about whether fear is justified this week. I am asking which businesses are getting stronger while fear makes their prices movable. That is a much better game. And it is the game I want you to learn, because if you learn it, you stop becoming a headline investor, you become a systems investor. A systems investor knows that money does not merely chase earnings. It chases bottlenecks, bridges, layers, dependencies, and control points. It chases whatever becomes hard to remove from the machine. That is what I want you to own. Not the noisiest story. The most necessary layer. There is one final thing I want to tell you, because it may be the most practical sentence in this whole piece. When the market is terrified, do not ask whether you feel comfortable. Ask whether the machine is becoming more valuable. Anyway, if the answer is yes, then fear is often a better entry point than comfort. And right now, while everyone is still busy staring at the war, I think the machine is becoming much more valuable. That is why I am paying attention. That is why I am buying. Not because I know exactly what tomorrow's headline will be, because I can see the rewiring already happening underneath it.